Gold probably ends up getting to $15,000 an ounce, and it's just a question of how it happens. If it's chaotically through market forces, or if it's through governments going back to a gold standard and naming 15,000 as the price of gold relative to their currencies. The guys who run the numbers to figure out where the U.S. would have to price gold in order to back the dollar by like 40%, which is how it was in previous gold standards. They say it's 15, 20, 25, $30,000 an ounce. So, it could be a really big number when the time comes.
What if you woke up tomorrow to see gold at $30,000 an ounce and silver blasting past $500? Not because of speculation, but because the financial system finally broke. That's the scenario financial analyst John Rubino says is not only possible, it's inevitable. We've entered the endgame of paper money. Governments are drowning in debt, central banks are printing trillions, and faith in fiat currencies is collapsing. Rubino warns that we're on the edge of a global monetary reset, one that could reprice gold to $30,000 and beyond. He calls it the moment when the illusion ends and real money takes back its throne. And when that happens, gold won't be going up. The dollar will be going down.
Soaring gold price is the same thing as saying a collapsing currency. So, if gold goes to $15,000 an ounce, that kind of implies a world where other things are way up too, and that's inflation, and that inflation is really destabilizing. So, I don't think we get to $15,000 an ounce gold organically via market forces without it being incredibly chaotic. It'll bring a lot of political turmoil with it. But, Russia and China are anticipating this by loading up on gold. So, yeah, let the price of it go up. That's somewhat destabilizing from a currency standpoint, but it also makes everybody richer in their country. China in particular is encouraging their people. Their central bank is buying gold, but they're encouraging Chinese people to load up on gold too. And India culturally they've been buying gold and silver jewelry to give as wedding gifts since the beginning of their civilization. And they're incredibly rich when you look at it that way. They've got a ton of real money sitting around in the form of gold and silver jewelry. So that rising gold price makes different cultures differently rich. And it definitely helps the guys who have been loading up on gold and silver for the last decade or 1,000 years or whatever your culture has been doing. And so it helps the BRICS countries in particular. It helps Russia, China, and in India and several other countries who have been doing this. And it gives them a chance to do the currency reset in a relatively pain-free way. By just bringing out that BRICS currency that's linked to gold and that they can all trade with each other with, something like that, might be almost literally pain-free for those guys. For the U.S., it's tougher because we get the world's reserve currency. And there's just so many dollars out there and so many people depend on dollars. And when we start debasing the dollar in a really aggressive way, which is the only way we get out from under all this debt, it becomes a huge problem for the rest of the world. That we said that once. I think it was John Connolly back in the 1970s, who was the Treasury Secretary for Richard Nixon, the last time we were aggressively inflating the dollar away. And he said, well, it's our currency, but it's your problem to the rest of the world. And we might not be brazen enough to say that, but we'll create the conditions in which it's true if it goes that way. So anyhow, gold probably ends up getting to $15,000 an ounce, and it's just a question of how it happens. If it's chaotically through market forces, or if it's through governments going back to a gold standard and naming 15,000 as the price of gold relative to their currencies. The guys who run the numbers to figure out where the U.S. would have to price gold in order to back the dollar by like 40%, which is how it was in previous gold standards. They say it's 15, 20, 25, $30,000 an ounce. So, it could be a really big number when the time comes. And, barring some kind of confiscation, it's going to leave the US and the rest of the world with a lot of rich stackers out there. The gold bugs will inherit the earth in that kind of a situation. So, and there's that. That's really the upside to all this, is that the right people are going to have a lot of capital when the time comes. The people who are smart enough to see the chaos coming and take some steps to avoid it. And so, then we will have the capital to help rebuild the system afterwards and protect our families.
Mhm.
So it
I,
won't seem, that'll seem like kind of a small thing when the time comes, because the rest of the world will be so chaotic, but it'll be something. The general idea of currencies being devalued at an accelerating rate until people lose faith in them, which is basically what a crack up boom is. We just give up on the currency. And what is $4,000 gold if not people, to an extent, giving up on the dollar? And what is silver at $50 with a bullet? Soon to be $100. What is that if not kind of sort of a crack up boom? The gold and silver story is very simple. Those are the old kinds of money that have held their value for 3,000 years. And that's where we hide out when we don't trust the currency managers of whatever money the country's government is using right now. So we pile back into gold and silver when we're afraid of inflation or debasement. And that's why gold and silver are going up right now, because we're afraid of what's happening to the world's big currencies. So that's super simple, easy to understand. And that we had a big correction right now is completely natural, because gold and then silver had huge runs. Gold was bumping up against $2,000 an ounce for like 3 years there. And then it finally blew through $2,000 an ounce, and then it blew through $3,000 an ounce, and then $4,000 an ounce without any real resistance. And you would think that big round numbers like 3,000 and 4,000 would just be stacked with people ready to sell.
yeah.
But it wasn't the case. Gold just kept on going up. And so finally, people had enough profits to protect that they decided to take a little bit of money off the table. When gold was $4,100 an ounce, that means that going back 3,000 years, everybody who bought gold had a profit to protect. And so it's no surprise that a lot of people sold at that point. And it's also no surprise that some governments decided to jump into precious metals and try to manipulate those monies down a little bit, because when they go up like that aggressively, it makes the big currencies look bad. So you had people who had bought along the way up selling, and you had governments manipulating the market via futures contracts and stuff like that. And so you had a reasonable correction, completely to be expected, not scary in any way. And something where, as long as you're in a bull market, buying the dip is what you should be doing. And it's been that way with equities for a really long time. The people who bought all the corrections and all the bear markets ended up making money in the end. And I think it's the same way with precious metals now. We've got a long bull market here. As long as governments are overspending and overborrowing, and in that way debasing their currencies, then capital will flow into gold and silver, because that's where you hide out in that kind of a situation. So yeah, the correction that we're having now is normal, natural, and healthy, and we should treat it as a buying opportunity, although I don't know where it ends. I don't know what the bottom of this correction is. Maybe we're already there. Maybe gold has to drop a lot further, but either way, it'll make gold-related things cheaper. And let's say you're buying gold mining stocks, that gives you a chance to put in some lowball bids just to see. You might get a chance to buy Agnico Eagle for $20 lower than today or something like that. And in the long run, that's a very good thing. So don't be spooked by this, because corrections in bear markets, basically that is their function. It's to shake weak hands out of the market and put the asset into strong hands who have no intention of selling at the current price. And that process is going on now in precious metals and to an extent the mining stocks. So don't let yourself be shaken out. It's reasonable to be the one taking some profit after a nice long run like this, but don't be spooked completely out of this market, because until we have the currency reset, the bull market for gold and silver is not over. So you want to stay with it while it's in its, let's say it's in the third or fourth inning of a long baseball game right now.
Mhm.
Um, there's no reason to get out now. Taking a little bit of profits here and there, that's fine, but don't bail completely and then move on to something else. Should still be a core holding for people whose main focus is the giant financial crisis that's coming our way.
Rubino's logic is brutally simple. If the U.S. tried to restore even a 40% gold backing to its currency, roughly what it held in the 1950s, the math demands a gold price between $15,000 and $30,000 per ounce. That number isn't guesswork. It's the revaluation needed to rebuild trust in money after decades of inflation and deficit spending. Across the world, others are already preparing. China is urging citizens to buy gold while its central bank quietly hoards tons every month. Russia has converted oil revenues into gold, shielding itself from Western sanctions. India, whose culture is rooted in gold, holds trillions in jewelry. Real money sitting in plain sight, as Rubino puts it. Together, these BRICS nations are building a gold-linked trading system, a direct challenge to the dollar. In that world, $30,000 gold becomes the new anchor of trust. Meanwhile, America is trapped by its own system. The dollar is still the world's reserve currency, but every new trillion printed weakens it. Rubino recalls Treasury Secretary John Connally's 1971 line, "It's our currency, but it's your problem." That arrogance, he warns, is back, and it's pushing the world toward a historic reset. Rubino describes today's environment as a crack-up boom, the final stage of fiat where people lose faith in the currency itself. Gold above $4,000 and silver racing toward $100 aren't bubbles. They're symptoms of collapse. He also highlights the silver time bomb. Industrial demand is soaring, inventories are shrinking, and exchanges are running dangerously low on physical metal. One delivery default, where traders are paid cash instead of silver, could ignite an overnight price explosion and expose the paper market illusion. And then there's the Fed. Despite record stock and housing bubbles, it's cutting rates under political pressure. Rubino calls it monetary suicide in slow motion. Short-term rates may fall, but long-term yields will rise as investors demand inflation premiums, tearing the system apart. That leaves two options. One, a 1930s-style deflationary collapse. Two, a hyperinflationary reset that forces a return to gold and a $30,000 anchor. Rubino says history is clear. Politicians always choose inflation. They'll print until the currency breaks. That's why gold and silver aren't trades. They're lifeboats. And the signs are already here. In 2025, gold hit all-time highs while silver reached a 14-year peak around $44. Central banks bought more gold than any time in modern history. India's silver premiums surged amid physical shortages. These are the warning tremors before the revaluation. Rubino's message to investors is crystal clear. Hold real metal, not paper. Treat corrections as opportunities. Understand that $30,000 gold isn't a dream. It's the logical end of the fiat experiment.
Well, yeah, the physical
Right.
silver story is a really big part of this because silver is an industrial metal besides being a monetary metal.
Mhm.
And the U.S., along with a lot of other governments, have decided silver is a critical mineral, right? And so there's a lot of buying going on out there that seems to be depleting the physical stock of silver that's on the exchanges.
Mhm.
And if we see a default on an exchange where they say, okay, we'll pay you cash for your futures contract, but we won't let you take delivery of the silver that you're entitled to do, that will send silver through the roof. So we should be looking for that as a real possibility here that gives it massive upside potential. The Fed is cutting interest rates at all in the face of a stock market bubble. I mean, did you see Nvidia just lately? It's now a $5 trillion market cap stock, which means it's about as big as California's economy. And the rest of the big indexes in the U.S., mostly because of a handful of tech stocks, are at record highs. House prices are as high as they've ever been. All kinds of other things are going on out there that would seem to call for higher interest rates instead of lower interest rates. And yet we got the Fed cutting interest rates dramatically. And I think it was Steve Bannon. I was walking my dog and playing a YouTube video. And I think they had Steve Bannon on, and he was saying that he thinks the Fed should cut by 300 basis points. And he's fairly influential in MAGA circles. And Trump, of course, as a real estate guy, loves lower interest rates.
Mhm.
So, another quarter point increase or cut in interest rates a month from now is not going to be very consequential, and it's not going to satisfy anybody.
Mhm.
So I think the process of easing aggressively is kind of baked into the cake here because let's say this stock bubble finally bursts. Well, what will that do? It'll make the Fed cut even more aggressively. So I think they're going to cut rates regardless. If things are just like they are right now, they're still going to be under political pressure to ease. And if some bubbles start bursting, then you're going to see massive pressure on the Fed to cut. So I think there's a decent chance that we end up with dramatically lower short-term interest rates a year hence. Now, long-term interest rates is a whole different thing because that's the bond market at work, and bond investors have to assume they're going to get a reasonable return on their bonds when they lend money in that way. And if you've got an aggressively cutting Fed, with the government running massive deficits at the same time, that might spook the bond markets. So lower short-term interest rates might give us higher long-term interest rates, which is a massive crisis in its own right. So in other words, to answer this question with basically one sentence, we have chaos ahead of us, and interest rates can do all kinds of things in the kinds of chaos that we're likely to see given deficits and current inflation rates and current prices of financial assets. So I wouldn't even come close to presuming to having a specific prediction about where we'll be 6 months from now or a year from now, because this is just all too chaotic.
Mhm.
I'm basically a gold bug and a silver stacker because of that, because I can't predict anything that's going to come. And because of that, stability looms large. It becomes the most valuable thing out there. So, some people buy volatility and they want to trade it. And I'm the opposite. I would buy stability with real assets that governments can't just create more of and inflate them away. And in that way, try to get through this in reasonably good shape with some capital intact. The Fed doesn't try to continue to inflate bubbles. Usually they inflate them until they pop, and then they try to stop them from destroying the economy. But now we're actively trying to keep some massive financial bubbles going. And we're doing it in the face of, well, the bubbles themselves, but also, like you said, a lot of recessionary indicators, which means I don't know what it means. It means that we're heading into times that are just incredibly hard to predict because if we were to raise interest rates to try to rein in these bubbles, because they represent massive inflation and a devaluation of the dollar relative to these bubble assets. So if you tried to intervene to stop that, you would blow up the financial sector and get a huge crisis.
Mhm.
But on the other hand, if you lean against these recessionary trends that you mentioned with easier money, then that makes these bubbles even bigger, and it makes the trauma of them bursting even more serious when that happens. Like, think about it. If we're kind of sliding into a recession, but not a violent one, things are just kind of slowing down. But then some giant stock index just crashes, drops by 30% in a couple of weeks, like the Nasdaq could easily do right now. Then that turns a slow drift into a modest recession, into potentially a 1930s style deflationary depression. And we're creating the conditions where those are becoming our choices. And there's no pain-free way out of this at this point. I'd go as far as saying that I think this is the death spiral of the fiat currency experiment, and that we've reached basically the end of it, where we don't have good choices anymore. So our only choices have basically boiled down now to deflationary crash, a la 1930s, or some kind of hyperinflation currency crisis that forces us to do a currency reset. And I think the latter scenario is way more likely because nobody voluntarily chooses a 1930 style depression. But people with a monetary printing press will always choose more inflation because it's not immediate. It might get them through the next year, in which case they get to retire, with their reputation intact. So they'll always choose that possibility over a guaranteed crash where you're the Herbert Hoover of this generation. So I think that's where we're headed is, we're going to inflate this thing until it blows up, and then we're going to do a currency reset. Or if we're way smarter than we seem at the moment, we'll do the currency reset in anticipation. You just on a Sunday night declare that you're back on a gold standard or something like that. And that would be by far the least painful way to do it, although it would still be painful. But nobody in charge of any major government has shown that kind of intelligence so far. So I wouldn't expect it to happen unless there's some people sitting around Trump's conference table when they're making these decisions who is more clear-sighted than they seem right now. So we'll see. But it all comes back to how you are going to defend yourself from this as an individual, right? It's basically an investment thesis. Everything we're talking about here is okay, chaos. It's coming. What do you do? How do you protect your family from something like this? Because we can't do anything about it politically, right? You and I, our votes count, kind of, sort of, but they aren't going to stop the institutional momentum of this thing. We are headed off that cliff regardless, because there's nobody in sight who, if we install them into the presidency, would be able to cut government spending by $3 trillion a year to get us back into surplus to start paying off our debts. There's no way that happens. So, the only thing that's left is to just keep inflating as long as we can, and then hope that the monetary reset doesn't blow up the world.
Every rate cut, every bailout, every trillion printed pushes the dollar closer to collapse. Gold and silver are no longer just investments. They're becoming the foundation of a new monetary system. So ask yourself, when gold resets to $30,000 an ounce, will you already own it? Or will you be watching from the sidelines as currencies burn? Share your thoughts below. Will governments repeg currencies to gold, or will chaos force the reset first? Could silver $100 plus be the spark that exposes the entire system? If you found this analysis eye-opening, hit like, subscribe, and turn on the notification bell so you never miss the next major shift in gold and silver markets. Because in this age of monetary reckoning, those who hold real money won't just survive, they'll own the future.